Our Friday, November 10th, 2023 edition. I'm Justin Klein, and I'm here to help you become a better investor. Now, first off, I want to thank everyone who showed up yesterday to our wealth webinar, and we covered a lot over about an hour and 50 minutes. We went way over. I think next time our goal is to probably shorten it up a bit and answer a few more questions. But I think we gave a good distillation of where we are today, where we're likely headed, where that recession is likely to hit. So probably sometime middle part of next year. And then what sectors were or are typically good going into a recession, during a recession, and coming out of a recession. Okay, but that was yesterday, and you'll be able to watch that webinar coming up here on our YouTube channel probably in the next week or so. So be on the lookout for that if you did miss it. But today we have a job. We have a job to do, and that is help you take that next step and your investment journey, which is different for everybody. Everyone starts at a different place, and everyone is looking to end in a different spot as well. But the commonalities are going to be financial freedom. That means something different for everybody, but those principles do remain the same. So I'm here to answer your questions and give you my unbiased perspective and data that we obviously use every day in managing portfolios and analyzing the economy. All right. Let's take a look at we're going to take a look at the market performance today. We're going to run down some show topics, but as usual, we're going to hit our first caller question now.
Hi, Justin and Steve. Longtime caller here, listener from the Midwest. I have a question for you. I'm looking at a fund, SDOG. I would love to know what your thoughts are on the fund. I believe it's a growth dividend fund. Contains good holdings from what I can tell, and I'd like to know what you think. Thank you so much for listening to all this. I really appreciate your help. Look forward to hearing it in the podcast.
All right. Looking at SDOG, which is the ALPS Sector Dividend Dogs ETF. Let's see. I'd have to look at really the criteria for this. Just looking it up here. Equal weight exposure to the 5 highest yielding stocks in 10 sectors across 500 of the largest companies. So looking at the S&P and then taking the 10 highest dividend paying stocks in those 10 sectors. Okay, so they call it cyclical value exposure with a dividend focus. Now, here's my issue with it, is that it's only focused on dividends. Yes, you're spreading it out amongst 10 different sectors. There's no real estate in here, but it's basically utilities, healthcare, consumer defensive, technology, industrial, energy, communication services, financial services, and consumer cyclical. There's about 5% in basic materials. I guess they throw that one in there as well. But the main issue I have with this, like I said, is that it is simply focused on the yield. And sometimes that can be good, and sometimes that can be very bad, especially in times like now where there are a lot of companies that are paying high dividends, but those dividends are in peril because they have a lot of debt in their balance sheet. That is either because they have poor businesses or because the balance sheet was just mismanaged. They paid out dividends, too high dividends for too long, or maybe they leveraged up their balance sheet to buy back shares. Whatever it was that got them into that place, there are many companies like that that are sitting with high dividend yields that are at a high risk of being cut. And so this is not a name that I would be buying because you're walking into too many value traps in my mind. And Morningstar kind of agrees with this. They have a 2 out of 5 star rating for this, 2 out of 5, and a negative view on it. Expense ratio is 0.36%. That's not crazy high. That's probably okay for a more actively managed fund, but I don't love the process here because there's no filter for earnings quality, business quality, balance sheet quality, etc. It's just being myopic and looking at dividend yield. And that's going to run you into way too many problems in this particular market. And you can just look at its top holdings and see the vast majority of them are in a downtrend, right? AT&T is in a downtrend. Obviously, you have Verizon in a downtrend. That's another one that is in a in the top holdings. Citigroup is in there. Kraft Heinz, Southern Company. So some of these are okay, but you're kind of mixing too many troubled companies with some that are okay. So I rather do a little work and find the ones with better balance sheets. All right, thanks for the call. Now we have a lot to cover over the next 40 minutes. Our main focus point looks into the story behind this question. What are the pros and cons of donor-advised funds? A donor-advised fund is a vehicle that allows investors to donate directly to a charitable fund while retaining control over the investments. So for this topic, I'm going to touch on charitable tax deductions with regard to donor-advised funds and touch on tax-free growth as well as investment flexibility within these funds. All right. That's our main focus point, but I also want to touch on a few others. One is in regards to manufacturing. The goal, I think, for both sides of the aisle and for most people in the country is to revive American manufacturing. Maybe not to levels like we saw in the early 90s or maybe go back to the 70s, but this is a goal for everybody. But the problem is our workers have become less efficient. Manufacturing here is becoming less competitive. And so while there's hopes and dreams of moving manufacturing back, companies aren't going to do it unless it becomes more efficient or workers become more efficient. So we're going to look at that. Also, yesterday, big news out of the Treasury market. This is something I talked about. We're in the first or second inning of our government debt levels becoming too large for the balance sheet room around the world, meaning individuals, funds, foreign investors, etc., banks. There's just not enough room for the massive amount of issuance. And yesterday was a 30-year Treasury bond auction, and it was one of the worst in years when it comes to its measurements. So we're going to touch on that. And then lastly, private credit. It's been booming, but there are increasing concerns. So we're going to look at a new analysis of a market that had boomed and is starting to crack. We also have some voice bank questions. One is on Freeport-McMoRan and the other is on Gilead Sciences. And we'll try to fit in an iTunes review question as well. Now let's get to our market performance for today. We closed out the week strong. There's no other way to look at it. It was strong across the board. Large cap, small cap, value, growth. The best return today, technology up 2.5%. So that got a nice boost. What else did well? Communication services, industrials were up 1.38%, in line with those industrials. Consumer cyclicals up 1.58%. So a lot of positivity around the market to close the week, despite that bad auction last week. And like I said, you had that powerful move off the Fed meeting, and you've had some consolidation, and today we had some follow-through. So not surprised as we inch closer to the holiday season. All right, and as we go to a break, please remind you to check out the newest InvestTalk Classroom series, episode 12, Investment Strategies for Short Selling Stocks. So you can learn more about that over on InvestTalk Classroom on YouTube. Just search InvestTalk on YouTube. Now, phone lines are open, waiting for your questions at 888-99-CHART.
When listener questions are played on the InvestTalk podcast,
how do you guys determine a value stock?
stock.
The caller voices are amplified many thousands of times.
Just wanted to get your opinion on JP Morgan and BAC.
How do you see this looking forward?
I'm 25 years old and have a question about retirement funds.
And the unbiased answers from Justin Klein.
That's why it's trading so cheap, because there's a lot of regulatory risk.
And Steve Peasley.
I kind of like it here. If I was going to buy Tyson Foods, this is where I'd buy it.
Benefit the entire InvestTalk community.
Thank you for what you guys do.
That's why 24/7, rain or shine, no matter how simple or how complex, your questions make a difference.
Symbol BKE. What's your outlook?
And InvestTalk is made better by the power of you. So don't forget to call 888-99-CHART. This is InvestTalk. For serious investors, it's all about achieving financial freedom. That's why the unbiased guidance offered by Steve and Justin is so valuable. The InvestTalk Anytime listener lines are open now, and Steve and Justin welcome your questions. Call 888-99-CHART.
Hey, Steve and Justin, it's Art from Tucson, calling in about Freeport-McMoRan. FCX is the ticker. Wondering if this is a good buying point here or a good point to begin to cost average in. I'll listen on the podcast for your answer. Thank you. Bye.
The simple answer is yes. This is near the lows we saw in May, and overall copper prices have held up. So I think this is a good opportunity for Freeport-McMoRan. Now, it's not my favorite copper name out there. I know it's the largest and most well-known, but there are better, more well-run copper miners. So if you're looking to get into copper, this is a okay choice, but it's not the best out there. But timing-wise, now between now and the end of the year, I think this will be a good time to kind of dollar cost average in until next year. All right. Now, when people take the time to leave an InvestTalk podcast review on iTunes, we'd like to thank them for their courtesy by getting to their questions quickly. Beirut Don says, DSKE, Daseke, D-A-S-E-K-E is how you spell the name of the company. They're out of Texas, and they provide open deck specialized transportation services here in North America. And Beirut Don says, just keeps going lower, but turning, question mark. You guys have covered it a couple times the past 2 years, small cap. They make flatbed trailers, and the past couple days has recovered very slightly. Your thoughts? My thoughts are this company is going bankrupt. This has a ton of debt. If you go and take a look at the market cap of $200 million and long-term debt of $650 million, it shows you that this business is struggling. And the balance sheet's struggling. And the chart is struggling. So this business is very mismanaged. Its history of cash flow is kind of all over the place. And they benefited from the pandemic, but earnings are expected to slow from $1.24 last year to 36 cents this year and 38 cents next year. All with free cash flow in decline. So I think the market's telling you that that debt level is unsustainable. And whoever and whatever got him into that situation is driving this company into bankruptcy. And it looks like this happened in 2016. When they lost a bunch of money. 2016, 17, made a little bit of money in 18 and 2019. They lost a bunch of money. And so from 2016 till early 2018, their debt increased by $600 million. And it's been steady ever since, but now it's too expensive for them to keep. And so that's why it is likely a bankrupt story and you want to sell it. All right, we're going into a quick break. Please remember that you can call now at 888-99-CHART.
Justin Klein is here and ready to take your calls live. InvestTalk, 888-99-CHART.
Now, my main focus point looks into the story behind this question. What are the pros and cons of donor-advised funds? And for this topic, I'll talk about charitable tax deductions with regards to these donor-advised funds and what type of investment flexibility investors have within these funds. Now, for investors who plan to make significant contributions over time to some sort of charity and want to maximize their tax benefits, donor-advised funds can be a pretty attractive option. So what allows people to do, or donors to do, is benefit from immediate tax deduction when they contribute cash or other assets. And that's usually what it is. It's other assets. Now, you keep control. I mean, you can invest it in what you're allowed to, depending on where that money's being held or where those assets are being held. But it's irrevocable. It's not like you can take back those contributions. So you retain basically an advisory role on how to invest those assets and how much the charities get over time. And then the investments can also grow tax-free over time. Now, the National Philanthropic Trust estimates that the assets in these funds total about $234 billion as of the end of 2021. So no small amount. And you can set these up at major financial institutions, mainly Fidelity, Schwab, and Vanguard. Those are kind of the big ones. Now, the 2018 tax law made it more difficult to basically deduct your charitable donations because most people, their standard deduction covers them to a point where those itemized deductions don't actually work. So this allows you to bunch charitable donations by making a large single donation in 1 year and then pushing small amounts out over time. So that's why donor-advised funds are becoming more and more attractive. And donors can contribute cash. Contributing cash can take a deduction of up to 60% of their adjusted gross income, up to 60%. So that allows you to give that big boost of tax savings in 1 year. But you can also, and a lot of people do, is contribute appreciated assets, stocks, bonds, mutual funds, even privately held business interest, restricted stocks, even cryptocurrencies. And when you donate those, you can take up to 30% of your adjusted gross income. So it's not quite as advantageous, but it gets you around potential large capital gains taxes on, once again, highly appreciated assets. So if you've held a mutual fund for a long period of time, or maybe a large cap tech stock for a long period of time, and you have big gains, you can actually donate those to charity through a donor advised fund and avoid taking that gain. Now you can then, once it is in one of those main brokerage firms, Fidelity, Schwab, or Vanguard, you can choose from preset options, and they vary depending on the broker. Can range from conservative all the way to fully aggressive, all equities. And sometimes you can even choose from individual single asset class options. Now, what are the cons? Well, while Schwab and Fidelity, there's no minimum amount, Vanguard Charity does have a $25,000 initial contribution. And there's administrative costs. They all charge under $500,000, 0.6% annually, so 60 basis points annually, and then over $500,000, it stair steps down. And then there's the fees of the particular funds that you might invest in. Okay. And this is different than a foundation, for example. If you're wealthier families, they often set up foundations, and that allows you to provide scholarships and fellowships and direct grants to particular families or individuals that are facing hardships, for example, or even run your own charity program. So foundations are a lot more flexible. This is kind of more for the upper middle class, shall we say, as opposed to the uber wealthy. Now, from a fee perspective, Vanguard's the cheapest, but I think Schwab's kind of the best mix between the cost as well as the investment option flexibility. But they all kind of have their pros and cons. But this is a good way, I think, for a lot of people to donate to charity and do so in a tax-efficient way while staying invested. So, very interesting, and we do get a lot of clients that inquire about this, and it's good that Schwab offers this because that's what we use. We use Schwab as our custodian. All right, now in the next Invest Talk, we'll look into the story set up by this question: what is an inverse ETF? And inverse ETFs can act like insurance for an investor's portfolio, but they're not recommended for everyone. That story Monday, but for now, I'm Justin Klein, ready to take your calls at 888-99-CHART.
This message is sponsored by Greenlight, the debit card and money app made for families. If you are a parent, have you noticed that as you are online, you may often see ads for various parenting hacks? In other words, quick solutions to tricky problems. Some hacks may be good ideas, others maybe not. Well, if you are committed to raising children that are made smarter and stronger by learning about financial responsibility, I encourage you to check out Greenlight. You see, as a debit card and money app made for families, Greenlight gives kids and teens an easy and fun way to gain financial literacy while providing peace of mind for parents. With Greenlight, you can send instant money transfers, automate your kids' allowance, and keep an eye on their spending with real-time notifications. Meanwhile, your kids can begin their journey towards financial autonomy by learning how to save, invest, and spend wisely. The Greenlight app includes a chores feature, so you can set up recurring or one-time tasks that are customized to your family's needs, and then reward your young ones for a job well done. Since 2017, Greenlight has helped more than 6 million parents and kids manage their finances. In fact, with Greenlight tools, families can even learn to invest together. Sign up today for Greenlight, the debit card and money app made for families, and get your first month free when you go to greenlight.com/investtalk. That's greenlight.com/investtalk to try Greenlight for free. greenlight.com/investtalk.
Your objective is to work hard, plan well, and achieve financial freedom, right? You're in luck, because Justin Klein is here now, ready to take your finance and investment questions. Call 888-99-CHART.
Hi, Steve and Justin. I am calling to get your opinion on Gilead. The symbol is GILD. I've been a holder of the stock. I bought it in the 70s per share, but then after that it went down. But now it's back up. So I just wanted to see what the outlook is for the company and just what your thoughts are, whether to hold or do you think it's time to get out and get into something else. So I'll be listening to the answer on your podcast. Thanks again. Bye.
All right, looking at Gilead Sciences, and this is certainly a complex one. A lot of pharma companies are, and Gilead is a very interesting one. They have two stellar businesses, HIV treatment business that does about $17 billion in sales annually. And then you also have a hepatitis C business as well. And the hepatitis C one has been kind of dwindling over time, mainly because it cures people. And so they don't have this kind of long-term capture, as opposed to HIV patients. Obviously, you pretty much have to stay on those drugs for life. And so what they've been trying to do is take that strong cash flow from their Hep C business and put it into biotechs that are mainly in the oncology space. So breast cancer drugs, etc. And that is risky. And they especially did that at a time where these companies were kind of expensive. And they built out a little bit of debt, but their business is very strong, although it's in decline. And that's kind of my issue here. Cash from operations peaked out in 2015 around $21 billion. Now it's at 8.4 and on a new downtrend because it did perk up in late 2021. You saw a move from 7.7 billion pre-pandemic in cash from operations to 11.38. Now we're back down to 8.4. It's on a downtrend. And that's what worries me here. The chart, it's kind of neutral. You had a big move late last year. That was good, and it's been kind of consolidating that move. That's a positive. But this week, you had a big reversal on earnings. Revenues were flat, earnings up 21%. Maybe that's because they were buying back shares. So I think there's better opportunities here. I think there's a lot of risk with that pipeline. And they're getting competition for their HIV drug as well from, who was it? Who launched it? It was another company that is launching a competitive drug. GlaxoSmithKline. Yep, that's it. So I'm going to give this one an eh. I think you have better options out there. All right, let's keep things moving and play two in a row from the InvestTalk voice bank. It never closes. It's 888-99-CHART.
Hi, this is Dan from Walnut Creek. I'm calling about Nuveen, NAC. It's currently paying a 4.44% dividend. We're kind of in a holding pattern with regards to Fed cutting the rates or raising them. And I think the next moves, when they do make a move, most likely the rates will go down. And I believe the Nuveen tends to rise in price when the rates go down. So would this be a good time to purchase some Nuveen, even if rates stay the same for a while, just write it out and collect that 4.44% dividend? Thanks very much. Bye.
All right, this is the Nuveen California Quality Muni Income Fund. And along with a lot of the muni funds, this went down dramatically. Last year it was down 25.5%. This year, so far, even after this bounce from $9.40 all the way to a little over $10 per share right now, it's still down 6.77% for the year. So, tough 20 months for the name, 22 months. And you're right, if the Fed is done raising rates and their next move is to cut and rates overall drop, this will rally and you will get a nice tax-free yield. So for a trade, actually give it a relative thumbs up. To buy and hold for the next 5 to 10 years, no, because I do think you're going to get a cyclical downtrend in rates in the midst of a secular uptrend in rates. Remember, there's kind of short to medium term cyclical trends, and then there's the longer term trends, and the trends in rates are going up. So you can do this for a trade, but not for a long-term hold. All right. Now, the KAPP Premium Newsletter was finished today and will be distributed to subscribers tomorrow. And we have a preview in the market conditions section. We explained that the financial markets saw gains and this week, and with major indices up about 1% midway through the trading session today. The growth occurred amidst fluctuating Treasury yields that saw the 10-year yield near opening levels following a significant increase in the Federal Reserve's Jerome Powell's comments and a weaker Treasury auction. So that was yesterday. It was all about Treasury auction, which I'm going to get to, as well as Jerome Powell's comments that, yeah, they could raise rates again, although I don't really believe it. But despite economic uncertainties and recent interest rate cuts, the economy has shown resilience, supporting equity growth year to date. Analysts predict a softish economic landing with a slowdown in growth and gradual inflation improvements. However, concerns about oil prices and market volatility persist. In the broader context of the American stock market, the Magnificent Seven, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla have been stronger, although Tesla has started to roll over. Their success significantly contributed to the S&P 500 index's outperformance compared to their international indices and small caps this year. This bifurcation in performance leads to divergent interpretations. Either the tech giants are overvalued and poised for a correction, or they will continue to outperform more traditional companies. All investors should reassess their portfolios, as excessive exposure to a few companies concentrated in one sector can lead to adverse outcomes, as you saw last year. So there's a lot more in the market commentary section in the newsletter. Now, stock ideas, we highlight a global financial institution operating in about 130 countries that provides consumers and businesses charge and credit card payment products. The company also operates a highly profitable merchant payment network. A weaker economy would be a major headwind on the company's spend-centric business model. So you may want to keep this on your watch list as you monitor for the economic climate. And we also look at the largest franchise bottler of wide moat Coca-Cola in unit volume terms. The company purchases beverage concentrates and syrups from Coca-Cola, which then it processes and packages for distribution on trade and off-trade channels, and mainly in the Latin American markets. So we name names in the newsletter. And you can subscribe over at InvestTalk.com. Now, let's go talk to Bill. He's in Northern California looking at Valero.
Yeah. Hi, Justin. Well, I owned this earlier in the year, and when it ran up to like $45 or $6, I went above that, but I sold it at that price, thinking that it was a little overpriced at the time, and I'm glad I did. And but I originally owned it around 100 and low hundreds, 105 or something. But it's coming back down again. I kind of like it as a dividend stock and long-term holding. But do you think this is a good value price right now in the low 120s?
That's funny. You say you bought it earlier in the year and sold it around the 140s, and we actually did the same thing for clients. So it was a good trade for both of us, and it has rolled over. And the reason we sold it was because the crack spread was rolling over, and that's kind of the biggest issue for Valero and any of the refiners is you're kind of at the whims of the crack spread. Is it going up or is it going down? And this is a good example. We talk about Exxon and Chevron and how those are very integrated energy businesses, and they have refining businesses along with their E&P business. And I say most people should go look for the good E&P companies because those are going to benefit from higher energy prices, clearly. Whereas the refiners, that can ebb and flow depending on supply-demand dynamics within the refining business, which can often diverge from energy prices. Right? It has a lot more to do with the broad economy, for example. And so Valero is more of that pure play refiner. And it's a good one, and no problem with it, but the technicals are now below all the major moving averages. And I don't see major support until you get to around the 110 level, 110, 112. We're at 122 now. So I think there's still potential more downside. It is a good company, though. We like the company, quality business, but it can be pretty volatile. And I would probably pass on it for now and keep your eye on it. Because even at 110, with the crack spread declining, that means earnings are expected to decline. Remember, they made $29 last year after making $281 the year before, losing money in 2020, mainly because of the pandemic. That's not really much to worry about. But even pre-pandemic, they kind of vacillated between $5 and $7 per share. So you're going to get a reversion to the mean. Actually, next year, $14.74 expected for next year's earnings. So I would keep an eye on it, and I would probably pass on it for now.
Very good. Thank you very much.
No problem. Thanks for the call. Now let's touch on manufacturing, and the manufacturing renaissance in this country has now become fairly bipartisan. It's just a matter of how do you accomplish it. Obviously, the current administration thinks chips and solar cell production, for example, are the main priorities. But in the industry world, there are a lot of other sectors, right? Food and beverage, for example, that's one. Obviously, your traditional manufacturing of physical goods. There's clothing as well. So there's a lot of areas that can continue to get a renaissance, but governments have to kind of create incentives around it, like they did with the chips market and clean energy markets. But the problem is that American workers are becoming less efficient. And labor productivity in manufacturing fell by 0.2% at an annualized rate this year. So the recent jump in GDP was mainly driven by services, which is 80% of the economy. And productivity in manufacturing has been on a secular decline since 2011, so 12 years. Now, American manufacturing employment fell sharply in the early 2000s, obviously because of China, exporting jobs to China. That's true. But adding insult to injury, productivity declined as well. So it reduced the incentive for American firms to invest in America. They're getting better productivity gains elsewhere. Now, during the 90s and early 2000s, manufacturing productivity actually soared. Why? Deploying computers, electronics to make the jobs easier. And it's not just in one part of the manufacturing industry. It's in all parts. From high-tech to non-durables to cigarettes and clothes. 14 out of 19 manufacturing subsectors saw declines during the 2010s in productivity. And we may be a technological superpower, but we don't use a lot in manufacturing. In fact, we rank 7th out of 15 countries in the adoption of robots per worker. South Korea, the world's leader, uses over 3 times as many robots per worker. Now, industrial productivity has declined throughout the wealthy world, so it's not just us. But we're below average. Now, the big question is why? Now, first thing you can say is the smartest minds are going more towards Wall Street, software, and the internet. It's more lucrative. So talent has been diverted away from your traditional industries. So part of it is a brain drain. Now, how do we fix this? Obviously, education. Getting education around the manufacturing industry more accessible and make it okay for maybe people not to go to college and go into more of the trades. I know when I was in middle school, we had shop class. They don't have shop class anymore. Maybe that's a problem. And government can help as well. So in China, they have clustered their manufacturing hubs into one city, like Shenzhen. And so creating these economic zones can be impactful as well that make it ideal for companies to set up shop in certain areas of the country. I think that'll be important as well. All right, we're heading to a break. Dan from Walnut Creek, he's going to ask about oil stocks, so hold on. You'll be next on InvestTalk.
Everybody wants a secure financial future, but getting there takes strategy and discipline. So Justin Klein and Steve Peasley are always ready to take your calls. InvestTalk, 888-99-CHART.
Now, on Fridays, I generally make time to fit in a quick rundown of key benchmarks, and let's do that real quick now. The 2-year Treasury yield at 5.05. Last week, it was 4.83, so up a bit there. 10-year, 4.63. Last week, 4.55, so that also rose for the week. Gold priced at $19.35 an ounce, down for the week. Silver, same thing, $22.23 an ounce. Oil selling at $77.26, the lowest in a handful of weeks. Last week was at $80.80. And the national average for gasoline, $3.39 per gallon. All right, let's go to Diane in Walnut Creek, who wants to talk about oil stocks. Dan?
Yeah, Justin, no, this is Dan. How you doing?
Doing good.
Good. Hey, so I've got about $35,000 in my brokerage account, and I plan on keeping it there for about another year. And I've got about 5,000 to 6,000 of that in oil-related stocks. I don't know if spread out through about five stocks.
So low to mid-teens.
Yeah.
Mm-hmm. Okay.
Yeah. And so during this pullback, would be a good time to add, or should I sell? I was thinking of selling, taking the profits, and putting them into like short-term brokerage CDs.
Well, obviously that'd be a safer. Obviously that'd be the safer play, but I rather sell into strength. Obviously, we've pulled back. Oil has reversed kind of the entire Hamas atrocity gains, shall we say, from what happened mid-August in Israel. A lot of that is positioning. There was a build in oil stocks that was unexpected, so that kind of brought prices down. Longer term, we're still in an uptrend, but we are at kind of the lower end of the uptrend range. So I will say that we are kind of at support. So this wouldn't be a time to be selling, but I think this is more you're feeling that volatility. You have to remember that. So when oil stocks rally, you have to remember that's when a more advantageous time to trim and rebalance into strength as opposed to weakness. So it's harder to do, right, when you're feeling good and you're making gains, and it's easier to kind of make yourself feel better when there's a pullback in particular asset classes like oil, which naturally is generally volatile. So it just depends on how disciplined you are. If you can be disciplined to sell in a rally, then that's probably a better way to go.
Okay, great. I appreciate it.
No problem. Thanks for the call. Now, lastly, I want to get to yesterday's Treasury auction. On the 30-year, the Treasury sold $24 billion in bonds, and the previous day, they were trading at about 4.65% yield, and after the auction, trading at 4.8%. And it was one of the worst bond auctions they've had in years. And basically, primary dealers had to buy a quarter of the entire issuance, basically saying they couldn't find enough other entities to take these on. And so the dealers had to buy them and take them onto their balance sheet, which is frankly not what they want to do, right? They're more intermediaries. Now they're going to have to go and find times and ways to unload these positions, which puts more strain on private balance sheets. And this is reviving worries, which I'm saying we are hitting air pockets with lack of balance sheet capacity to handle the massive amount of debt that's being issued. And so I highlight this because this is the most important macroeconomic factor in the markets today, is how governments, mainly the U.S. government, is going to finance themselves going forward. And what pressure does that put on interest rates, on banks, on the general public? And in some ways, in the short term, it actually is stimulative, because these rates they're paying coupons going out to the public. It's a form of fiscal spending. But clearly we are in, I think, the first or second inning of the Treasury bond market becoming majorly dysfunctional, and it becomes a crisis, not just here in the country, but globally because the fact that treasuries are a store of value for the rest of the world. So something to watch for. It's not going to unfold and spark a big kaboom tomorrow or next month or even next year. But it is something to watch to see how the powers that be, Treasury and the Fed, kind of manage through this. All right, I'm Justin Klein. This completes another InvestTalk program. Steve Peasley and I thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play, and be sure to rate and review. And it's official. We have now surpassed the 56.7 million download mark. We keep climbing, all thanks to you. Independent thinking, shared success. This is InvestTalk. Good night. Enjoy your weekend.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein.